And this is very important because if you're in a successful position, many people like to pyramid their profits and add more contracts on, and because of the mark-to-market feel of futures, you can actually pyramid and grow your positions faster in a successful market than stocks, so you don't have to put up additional capital. Also, margin is operated differently. Margin in futures really is earnest money. They've done some calculations to decide the volatility of the market, to decide the number of players in the market, and then how much earnest money or good faith deposit needs to be put up in order for you to hold a position. And once they create their calculation, the proportion of the margin you have to put up to the actual value of the contract can be, with single stock futures, it's 5 to 1. And in some instances, it can actually be 10 to 1, 20 to 1, or more, depending on the aggressiveness of the players in that marketplace. Then the supply of futures contracts is actually unlimited. And the reason this is so is because, as we talked in the last video, we talked about how the clearing firms actually take the opposite side of every trade that you make. Well, no matter how many people come into the market, as long as the contracts haven't expired, they'll create as many contracts as necessary to create the liquidity of the demand. So you can have an unlimited number of long positions in coffee, an unlimited number of short positions in cattle, and so on and so forth. The only time it matters that the contracts have to shake out is when the expiration date gets close. And this is very important because, as you notice, many, and we'll talk about this later, many contracts will speed up towards the end of their life cycle, near the expiration, and you'll see people getting out of the marketplace because they don't want to make or take delivery. And some of the artificialness of that contract starts to dissipate. And there's trading opportunities in that. Another concept that's important to understand is shorting is designed as if you had a cash position outside of the market. Shorting is actually selling something you don't own. Well, in futures, it has a different connotation. Since hedgers drive the futures market, shorting is treated as if you're actually selling into the futures market because you hold a long cash position. So you own the cash, and you own the actual product, be it the S&P 500, or you own live cattle or coffee, and you're protecting your investment from falling by shorting into the futures market. And as you'll notice as we go further, shorts actually have a lot of advantages over longs in the futures market. And then the core concept is speculators and hedgers have to deal with all of these issues. Hedgers tend to get preferential treatment, though. For instance, hedgers have to pay less margin than speculators when they get involved. And again, this goes back to the concept that hedgers are believed to actually own the cash position, so when they short, they're just protecting their underlying assets, and so they're given preferential treatment. It's very unique. Now here's an example of a futures contract, and this one is a coffee contract, and the breakdown falls into a lot of different categories, and the breakdowns are actually in bold. And what's unique about this contract is that it's not unique. This is how most futures contracts look. They are very simple. They have the trading units that they discuss. For instance, on the coffee, we have trading units that are 37,500 pounds, approximately 250 bags. So one contract of this represents 250 bags of real coffee sitting somewhere in some warehouse. The trading hours on every futures contract is specific to that contract, and every contract has different time frames based on the hedger's schedule, not on the speculator's schedule. So in this contract, we have coffee trading from 9:15 a.m. to 12:30 p.m., and that's typically Central Time because most futures are traded in Chicago. And it talks about the closing period that ends at 12:28. And then you look at the price quotation, and the price quotation falls into cents per pound. So as you're starting to profit, 1 cent has a value for you, 2 cents has a value for you. Then we go to the next level, and we see delivery months. And with coffee, there's actually 5 delivery months. You have March, May, July, September, and December. And since we're in the month of February, we're looking at March would be the spot month. And this has a lot of significance, and we'll continue to discuss how the spot month interacts with the cash month. You have the ticker symbol, which is KC for coffee. And then you have a minimum fluctuation. Since futures move in such micro movements, like we said, cents per pound, sometimes in order to make it more convenient for the traders, they move in different increments. And in this one, we have coffee moving at 5 cents per pound, which equivalates about $18.75 per contract as it moves. And then we have the last trading day, the first notice day, and the last notice day. These are very important time frames because when you buy or sell this coffee contract, if you're holding on to this contract during the last trading day, first notice day, and the last notice day, different things are required of you. And at some point, you may be required to make delivery or take delivery of this coffee. The next is daily price limits. Fortunately, in coffee, there are none. Now, daily price limits just mean that during the day, the contracts are only allowed a certain amount of volatility. For example, when live cattle was moving very quickly during the mad cow scare in Canada and then the subsequent mad cow scare in America, we saw the live cattle move 150 points in a day and want to go further. But because of the limits on the amount of movement that the CFTC and the Chicago Mercantile Exchange and Chicago Board of Trade placed on live cattle, you could only see live cattle move 150 points in a day. And so it actually took them to write a special ordinance and a special bill in order to expand the limits of that particular contract from 150, and they later expanded it to 300. And still, when the market continued to move, they had to write another new law allowing it to go from 300 to 600 points in a day. So it's very important to understand the limits that happen in your market, because if you're caught on the wrong side of a limit move, it can actually be fatal. And so it's kind of good to understand that if you're in a market that has limits, for instance, like the cattle, if it's approaching 120 or 130 or 140 and it's against you, it might be best for you to move out before you end up being what's known as lock limit and stuck in your position actually until the next day, in which you may continue to find yourself in lock limit with more losses. And this is, again, a very unique unique framework for futures. And not every futures contract has it. Just understand that some do. Then we fall under position limits. And as we mentioned a moment ago, March is the spot month for February. And in the spot month for coffee, you're only allowed to have 500 contracts as of the first notice day of the expiring month. 500 contracts is a huge amount, and the only people who would want to hold on to practically 15 million pounds of coffee would be a major corporation or hedger selling or buying coffee. So it'd be a rare instance where a speculator would actually participate at that level. But it's important to note that because during this contract month, on the first notice day, you have to take delivery. So they're limiting the amount of contracts available. And we'll talk a little bit more of how first notice days and last notice days affect the actions that happen in the market. Then we go to standards, and we look at in this one, it's based on a particular type of testing in which you test the grade of the beans, and they do a cup testing for flavor. And what they do, the reason why we have standards in futures is the core of futures market as opposed to the forward market, where everything is customized. And so this standard for coffee creates an even footing for everyone who wants to use futures contracts to protect themselves. And whatever the standard is, there are plus or minus differences based on that. And as we go down, we see delivery growths, which is basically any country. And then the next is the differential. So anything that happens outside of the standard has a plus or minus. In different countries, as you'll see a full list here of Mexico, Salvador, Guatemala, have either they equal the standard, such as those countries, they have basis, so that means they equal the exact value of whatever the futures contract is,